Welcome back to Investing Talk podcast,
Today we're looking at stock.
the specialist cloud infrastructure provider that really sits squarely at the heart of the AI race.
It really does.
And as usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Let's do it.
The way I see this company, its entire investment thesis, it kind of boils down to this fundamental paradox.
Okay, a paradox. What do you mean by that?
Well, they have what is arguably the most assured revenue stream in high-growth tech right now. I mean, it's almost guaranteed.
Right.
Yet the market keeps treating them like this highly risky startup that's struggling with execution.
That's a powerful framing. So help us unpack that. What exactly makes this revenue stream so assured, especially in a field like AI where, things change almost daily?
It all starts with their core position. They're a pure-play AI GPU cloud provider. That's it.
So they aren't trying to be everything to everyone.
Exactly. They're not running generalized cloud services for web hosting or whatever. They are purpose-built for one thing, the most demanding AI workloads. And because of that focus, they're just capturing this explosive, necessary growth.
And we really saw that in the recent numbers, didn't we? Q3 2025 was, it was eye-catching.
Absolutely.
Revenue hit roughly $1.4 billion. That's something like 134% growth year over year. That's sustained hypergrowth.
And looking ahead, their full-year guidance for 2025, it just reinforces that. They're projecting between 5.05 and 5.15 billion.
So that implies what? 174% year-over-year growth? That's massive.
It is, but you know what? That growth rate, it isn't even the most compelling part of the story.
It's the visibility you mentioned earlier. That's what's so unusual here.
Precisely. We have to talk about the sheer size of their revenue backlog. $55.6 billion as of the end of Q3.
55.6 billion. That's a number that I think a lot of investors just can't really wrap their heads around.
Right, because it's not a pipeline. It's not speculative demand that might happen. This is contracted revenue, mostly from non-cancelable take-or-pay deals.
So people are locked in.
They are. And if you break that down, about 40% of it, so what's that, $22.4 billion, is contractually due over just the next 2 years.
Wow.
Think about that. You have a high-growth tech company that can look 3, maybe 4 years out and tell you almost exactly how much money is guaranteed to come in.
Yeah, a typical software company gives you, what, 3 months of guidance, 6 if you're lucky? This is a whole different ballgame.
It is. And that level of visibility, it only happens when you're solving a huge structural problem in the market.
Which in this case is the AI infrastructure shortage.
That's the one. They're one of the only places where the big players, the ones who have to secure AI capacity, can actually go and get it.
Okay, so let's shift from that top-line demand to the financials, because that's where another surprise comes in. Despite this crazy growth, and building data centers is not cheap.
Yeah.
The margins are incredible.
They're crucial to the whole thesis. Adjusted EBITDA surged to $838 million in Q3. That's a 61% margin.
61%. And the gross margins are sitting at what, 73, 74%?
73.9, yeah. These numbers show they have serious pricing power. Customers want guaranteed access more than they want the lowest price.
But okay, here's the question I always get. If the margins are so strong, why is the company still reporting losses? Why is it unprofitable?
That's the tricky part, and it's where a lot of investors get stuck. The answer is, it's intentional. This is a deliberate strategy.
A strategy to lose money.
You could call it that. It's a hyper-investment phase, an infrastructure land grab. They're purposely spending capital way ahead of recognizing that revenue.
So they're building the foundation today to service that $55 billion backlog tomorrow.
Exactly. They spent $1.9 billion on capital expenditures in Q3 alone. They brought in $1.4 billion. They are losing money today to secure a massive future stream of high-margin revenue.
Okay, that makes sense. And that naturally brings us to the debt. They're holding a lot of it. $18.8 billion. That looks like a huge risk on the surface.
It does. And that's the skeptic's first point of attack. How much risk is baked into that number if, say, the economy turns or a competitor emerges?
Right. Is this good debt or just a house of cards?
Well, this is the critical distinction. This isn't just generic corporate debt. It's strategic infrastructure financing. Most of it is structured as term loans that are secured by those very take-or-pay contracts.
So the collateral isn't just the servers, it's the legal obligation of companies like Microsoft and Meta to pay up, whether they use the capacity or not.
That's what take-or-pay means. The banks aren't lending against today's cash flow. They're lending against the guaranteed cash flow from investment-grade customers 3 years from now.
And we're seeing that confidence reflected in their borrowing costs, right?
We are. Recent debt tranches were priced, 900 basis points lower than their older non-investment grade debt?
Yeah.
That's a massive de-risking signal from the credit markets.
They also just upsized a big convertible note offering, $2.25 billion at a really low 1.75% coupon. But they use something called capped calls. Can you break that down for us?
Yeah, absolutely. A capped call is basically the company buying insurance on its own stock.
Insurance.
Right. So with convertible notes, if the stock price shoots up, the company has to issue a lot of new shares, which dilutes everyone else. A capped call puts a ceiling on that dilution. It's management signaling they think the stock is going way up, but they're protecting shareholders from the side effects.
That's a pretty strong signal of confidence. Okay, so we've got the demand, we've got the smart financial structure. What about the moat? Why them and not Amazon or Google?
That's the million-dollar question.
Hmm.
I think it comes down to their positioning. They call themselves the essential cloud for AI. They are not a generalist.
And that specialization is built on their tight relationship with NVIDIA.
It's more than just buying chips. They are deploying the absolute cutting-edge stuff right away, like the GB300 NVL72 systems.
That's the new integrated rack system, right? The liquid-cooled one.
Yeah, it's designed from the ground up for dense AI training. The big hyperscalers, they're often stuck with older cooling tech or power limits built for general computing. It's harder for them to pivot their massive legacy infrastructure.
So stock can offer better performance per dollar for these specific workloads.
That's the advantage. And once a big customer designs their AI models around that specialized stack, moving becomes a huge, expensive headache.
And the customer list really backs that up. You said 60% of that backlog is from investment-grade customers.
We're talking blue chip names. Microsoft, Meta, major banks like Mizuho.
Yeah.
This just landed a big deal with Runway for AI video and even NASA's Jet Propulsion Laboratory. It's a fortress.
And they're now trying to expand that fortress into the public sector with a federal unit.
Right, which opens up this huge market that needs high security and high performance. It's just another barrier to entry, a very smart long-term move.
Okay, so we've painted a pretty rosy picture. We have to address the bear case. Let's circle back to those execution issues that have caused all the volatility.
The primary risk, and this has caused all the negative headlines, is supply chain execution. I have to stress this.
Yeah.
Not a demand problem, it's a timing problem.
They actually had to lower their 2025 revenue guidance, not because customers left, but because of delays in getting powered shells.
Exactly. And a powered shell is just the finished data center building, ready for the servers. They had the chips, they had the customers, but they literally didn't have the buildings ready to plug everything in.
And that timing news caused the stock to drop, what, 16%?
Yeah.
Which then triggered those class action investigation headlines.
It did. And, those investigations often follow any big stock drop, but that headlines create a lot of fear and uncertainty. The market just hammered them for that execution fiction.
So how are they fixing it? They can't be at the mercy of third-party builders forever.
They're not. They're aggressively moving to diversify suppliers and, more importantly, investing in their own self-build capacity. Places like New Jersey and Pennsylvania. They're taking control of their own destiny.
And let's just address the volatility head on. The stock is down about 60% from its highs, even though it's still way up for the year. And then you had those insider sales.
Yeah, from the CSO, CFO, GC. That kind of volatility creates a real sentiment problem. And while those sales were almost certainly pre-planned, the timing just gives ammo to the bears.
So you have to look past the sentiment and at the actual valuation.
I think so. Given that 174% growth rate, a valuation around 8.4 times 2025 revenue just looks cheap. I mean, materially cheap compared to peers.
You just don't see triple-digit growth trading at that kind of multiple unless there's some kind of perceived risk.
And that November sell-off, which was all about timing noise, you could argue it created a really asymmetric entry point. The market priced in the delay, but sort of ignored the certainty of the revenue.
So what are the catalysts we should be looking for that could get the stock re-rated?
They're very near term. Q4 2025 earnings, which should be late January or early February 2026. That will be absolutely critical.
What will you be looking for?
An update on the supply chain normalization, any sign that those bottlenecks are easing and that the 2026 backlog conversion is on track.
Mm-hmm.
Plus, any good news from the federal unit.
So the entire story really comes down to this one core tension, doesn't it? Massive contracted demand with these incredible 61% EBITDA margins.
Bottlenecked by the simple physical act of building stuff.
Right. It's a company that is intentionally losing money today in this aggressive land grab to secure a $55.6 billion future. And the big question for you, the investor, is how long are you willing to wait for that cash burn phase to end and for that margin to finally turn into positive free cash flow?
Yeah, and if you connect it to the bigger picture, the market is punishing the timing risk. But it's ignoring the fact that this company has had to turn customers away because the demand is so intense. When those data center bottlenecks finally ease, the acceleration of all that deferred revenue could be one of the biggest stories in tech over the next couple of years.
Don't miss our future discussions on the AI infrastructure race. Subscribe, like, and comment to support the show, and we'll catch you next time on Investing Talk Podcast.